Okay, welcome to another run through of the weekly top 5 charts of the week. This is a free email that goes out to subscribers of the website. It'll start off with number 1 here. Getting straight into it is Eurozone credit risk pricing. And so what we've got here is in the blue line, it's a measure of sovereign credit risk. And so that's basically the benchmark 10-year bond yield for the Eurozone. So pretty much representative of countries across the Eurozone. It's going to be obviously impacted a lot by those who are seeing substantial movement or deviation from sort of their average. And that is a spread against German 10-year bond yields, which is kind of like the core benchmark or safe haven bond market in Europe. And basically, well, you can see there in the indicator that during the Eurozone crisis, that measure spiked up substantially. And you also see that in during 2008, in the financial crisis, that it actually rose quite significantly, certainly significantly compared to where it had been during the more sort of idealistic days. And one thing that I actually just want to point out quickly there is you can see there that post-financial crisis, the sovereign credit risk indicator actually settled into a new range or a new plateau. It never went all the way back down to the pre-financial crisis levels. In contrast, if you look at the black line, that's European high yield credit spreads. It did go all the way back down. So, basically what you're seeing there is that, markets are saying, well, sovereign credit risk is, we've learned our lesson here. And then, basically saying that we didn't learn our lesson for corporate credit spreads. And to be fair, there's a few things going on there. Eurozone, the European Central Bank is still engaged in quantitative easing, and part of its quantitative easing program is the purchase of corporate bonds. So, it's obviously having a suppressive effect on the credit spreads there. But the key point of showing this chart in the original article and also in this weekly email is that both lines are starting to pick up. You can see there that the corporate credit spreads clearly have bottomed. You look at history, they tend to go for these periods where there's sort of calm and complacency, and then it'll sort of reach a climax low before turning upwards, and usually it'll turn upwards because the economic picture is deteriorating. We have seen some softening in the economic data there as well. But at the moment, that risk flare up with the geopolitical situation. I'm not going to go into detail on that, but I will note that just looking only at the indicator, that when you have these flare ups in whether it's credit risk pricing, you can see back there in the late 90s, and then in the post-dot-com boom recession in the 2008, obviously during the debt crisis, and then again during the commodity crisis, and again post that. Basically, it generally takes a couple of months at least for these flare-ups and risk pricing to run their course. So, on that note, I would say that it's not over yet for Europe, and I think that it's worth a little bit of caution there, and certainly keeping charts like this, front and center, front of mind on the risk radar. And speaking of charts to have on the risk radar, quantitative tightening is well underway here. You can see this chart showing you the cumulative difference in Fed balance sheet versus the peak, and pretty much what I'm trying to show here is the cumulative amount of balance sheet rundown or cumulative amount of quantitative tightening. So just as a side note, quantitative tightening in this context is basically the Fed stopping reinvesting, progressively stopping reinvesting maturing principal of its current holdings. So it's both tapering because it's purchasing less from the reinvestment, but it's also balance sheet rundown or reduction, in a passive manner. It would be an active manner if it actually was outright selling securities, but it's not doing that. So, well, whatever way you look at it, it is a move to tightening financial conditions via the balance sheet versus, in the initial quantitative easing phase, it was easing financial conditions via the balance sheet. So definitely, it's well underway now, and the total amount is starting to look material, and it will look more material by the month, as I think it's July and also October, the cap will increase, so it'll increase to a total potential pace of 50 billion per month from Q4. So it's a pretty key development, and it's coming full circle of the monetary policy experiment, and definitely one to be on top of there. Number 3 is an alternative view of volatility, very much a partner chart for the QT one, because globally we're seeing monetary policy tides are turning, and if monetary policy easing was a suppressive or restraining factor for volatility, I think it stands to reason that that monetary tightening rather is going to be something that's going to be consistent with higher volatility. And the reason is because monetary policy tightening involves all sorts of things like sharper movements in currencies, more volatility across core financial markets, exchange rates, etc. And that's going to naturally create winners and losers within stock markets, and it's going to bring things closer to the end of the cycle, because that's typically the pattern for a business cycle. In the early stages during a recession, you get a whole bunch of easing, and that helps boost growth, and then towards the end, central banks are trying to sort of stop things from overheating, and usually to do that they have to slow down growth via monetary tightening. So base case there is that volatility at least stays high, if not goes higher, or certainly relative to the extreme low point that it got to, which was 50-year low. So it's a pretty interesting chart to keep on the radar there as well. Usually when it turns out from such extreme lows, it just keeps going. Number 4, probably another good one of sort of showing where we are in the cycle. We had this sort of profit recession, profit slowdown in 2015-16, and a lot of that was down to commodities, but also emerging markets in China slowing, and that actually bounced back from then. Part of that was actually a new round of central bank easing, monetary stimulus and fiscal stimulus in China, and that helped us see a new leg of the bull market there. And we're seeing that median global profit margins, and that's across 45 countries, is at a pretty solid pace, and that's generally what you see in the latter part of the cycle. You can see there in late 90s, in the actual peak there, same thing in the mid 2000s. Would say it definitely speaks to solid fundamentals for global equities, but then from a timing standpoint, it tends to be slightly more rewarding to actually buy when profit margins are in a slight downturn versus towards the peak, and that just speaks again to the progression and repetition of the business cycle and the market cycle. Last one is a look at an interesting sort of correlation here. So we've got a scatter plot. On the one side we've got 10-year government bond yields, and across the bottom we've got composite governance ranking. So the composite governance ranking that I've built there is a combination of factors from the IMF, World Economic Forum and World Bank, and basically the higher the number is, the worse the government's quality is, particularly relative to the rest of countries. So you can see that the kind of names that we're seeing at each end of that spectrum, generally seeing, developing, emerging, frontier type of countries down the lower end of the governance rankings, and it's typically developed economies at the other end. And we're seeing here basically reasonable link between the level of the 10-year government bond yield and the quality of a country's governance. So the worse the governance is, the higher the 10-year bond yield tends to be. And that makes sense. There's sort of a governance risk premium there, if you can think of, if you think of it that way. The other thing is that those countries tend to see, they tend to be developing countries, and they tend to have higher rates of growth, higher rates of nominal growth, so higher inflation as well, and that those kind of factors are definitely consistent with higher bond yields. So it's an interesting correlation there. It's decent squared, and it lines up with what we see also in expected equity returns, or even other metrics like historical volatility. And that, again, it's just a kind of a repetition of that, that fundamental axiom of investing, that, risk and return are related. Higher returns are generally consistent with higher risk. And, from a practical standpoint, when you have an established relationship like this, then, it can help you actually, make some differentiation between the countries. For example, countries that are showing a bond yield that is particularly high relative to that line, to the regression line, that's basically, those are outliers, which look interesting from an investing standpoint, because if the bond yield is much higher than, the governance ranking is suggesting, then that could be an opportunity, and vice versa on the downside. So it's an interesting chart there, and the interesting concept as well, the governance ranking, governance risk premium. And that is that. If you've got any questions, comments about this, do put them in the YouTube section below. Otherwise, go ahead and subscribe to the channel so that you do not miss out on any future updates. And if you want to see the original version of this email, I will put the link in the comment and the about section of the video.